and get started. Good morning. Thank you for tuning in to the Multifamily Market Update brought to you by the Multifamily Investment Advisors team here at KW Commercial and Keller Williams One Chicago, backed by those global powerhouses where we've actually achieved basically over 407 billion in sales volume for 2020. And we're able to actually connect those investors to our large network to preservation and legacy capital through the multifamily assets. I'm Travis Montgomery. I'm the Director of Marketing here on the team. And today, in today's webinar, we'll actually be going over some pretty interesting information today that we're actually seeing in the market. We'll be starting off in the capital markets today, and I'll let our financial advisor on the team, Drew Heitzman, actually go over that information.
Hey, good afternoon, everyone. My name is Drew Heitzman. And so first, I'm going to share my screen if I can. Can't screen share right now, but so basically the 10-year treasury is currently sitting at 1.69, which is a 30 basis point increase from when it was.
Screen sharing is working for you now, Drew. Sorry about that.
Okay, thank you. So just to give everyone an idea, here's a chart of the 10-year over the last year. And as you can see, it's over doubled since this time of last year. So as I was saying, it's up nearly 30 basis points since it was at 1.41 just 27 days ago. And here's that monthly increase. It touched a 52-week high at 1.73 on March 15th, and it's down to 1.67 right now. So it's been a volatile way up. But many bond traders and analysts on CNBC and articles I've read on the New York Times and on Bloomberg believe that 1.95 to 2% should be expected at some point this year, but it's going to be a volatile way up as it has been. Rates have jumped up over the last year, yes, but they're still relatively low compared to rates over the last 5 years. And as you can see, they touched around 3.21 at one point in 2018. And then one deal I wanted to bring to everyone's attention, this is a national deal I found. It was a 108 unit Class A apartment that refinanced a fixed rate non-recourse loan at 3.63%, which I wanted to bring to your attention because our team recently got a quote for one of our listings, a 4-unit property in Logan Square at about 3.62 at a 3.62 rate. So I think based off those two deals, spreads are sitting, I think we can assume that they're going to be sitting at around 200, which I have another chart to show everyone. These are the lending spreads, which is the difference between the 10-year rate and what lenders are actually providing. So as you can see, spreads have been around 150 pre-pandemic. And right now, the last couple of months towards the end of Q4 of 2020, they were around 250, but right now they're sitting at around 200. And when these spreads are lower, that kind of indicates that the economy is improving and interest rates are rising. So it like these spreads are going to be trending towards the pre-pandemic level of around 150.
Thanks so much, Drew, for that information regarding the interest rates and the capital markets and providing those updates. Now in Chicago, of course, there's still developments that's underway, with the most recent being the esports development in the Bronzeville community. Jason, can you provide us with some information in regards to some new upcoming current developments in Chicago?
Yeah, absolutely. Thanks, Travis. Good afternoon, everyone. This week, I wanted to kind of touch on some developments that are going on with the Invest Southwest initiative in Chicago. A couple of weeks ago, they announced some of the winning proposals. And I just wanted to share a little bit of information about some of those projects that are going to be coming soon. On the west side of the city, in the Austin neighborhood, right on the corner of pretty much Austin or Chicago Ave in Laramie, it's actually some vacant land in a landmark building that is basically going to be redeveloped. So the former Laramie Bank building and approximately about 20,000 square feet of land that's behind the building is actually going to be renovated and developed into some mixed income and residential living space, which is going to have, some social space and, green roof and things like that. And the old Laramie building is actually going to it's going to be about $40 million project, but it's going to be the old Laramie Bank building is going to be renovated into having going to be a blues museum, a bank branch, a cafe, a business incubator, and it's going to be a nice project that's going to take place in the Austin neighborhood, and that's one of the exciting winning proposals with this Invest Southwest program. And on the southern end of the city, in the Auburn Gresham area, it's actually some more development going on as well. If you look at the intersection of Hosset and 79th Street, it's going to be about 23,000 square feet of vacant land that's going to be developed into about 56 units of affordable housing. And it's also going to have some retail space on the bottom of that development as well. Now, this one is really cool because the new 56 unit affordable housing is actually going to be across the street from the Chicago prize winning Healthy Hub, which is a little bit of information came out earlier this year about it, but it's going to be an adaptive reuse project that's directly across the street. That's going to have a ton of new things like a garden, playground for the residents, and private and public open space for the community. So within that small little pocket in Auburn Gresham, it's a ton of reuse and adaptive projects and developments going on, which is really exciting for the city. And those are some two projects that were announced earlier this month with the Invest Southwest program.
Definitely some interesting information there, Jason. And I encourage anyone that wants some additional information regarding those upcoming developments to please leave your information in the chat channel. We'll gladly reach out to you and follow up and provide you with some articles and some additional information regarding those developments. So in regards to those developments and in regards to the capital markets that Drew spoke upon, Vince, can you provide us with some information as to why investors are considering Chicago still a desirable landing spot?
Sure, Travis. Thanks for passing me the ball there on that. With regards to Chicago and investor confidence in that market, certainly low-hanging fruit, we do see some objections that arise. That involves, maybe some recent crime reports that they may have looked at, controversial politics. You see a population decline over the past 9 years, but there are caveats to these objections. With the population decline, certainly there's a population decline, but it's relatively flat, not a very sharp decline that we've seen. And nonetheless, Business Insider magazine recently ranked Chicago as one of the top 5 places to purchase a rental property. In regards to the average sale price of a property that it trades for, in New York, you're seeing $1 million as the average. In LA, you're seeing the average at 500,000. In Chicago, you're still seeing just above 300,000. So for us to be in the top 3, actually the 3rd most populous metro area, the entry level price is certainly markedly lower, and it provides the best environment for investors to gather an under market value property and squeeze the most profits possible out of it. With that high level of population, we're seeing a population of over 50% renters. This is the only market in the nation with rental population that high. Those renters are renting at a rate of under 20% of their income. So not only is this a primary destination for investors, but this is right now a primary destination for renters, for employees that may be looking to be mobile, come to a city where 36 Fortune 500 companies host their headquarters and find gainful employment and be able to still be mobile and be in that rental market. So investors are definitely flocking here. Certainly I am getting calls from local investors, who might be skittish about the upcoming tax assessment or something very short term and, be like, oh, I'm tired of Chicago. But I guarantee you, for every one investor that I'm seeing, given that kind of sentiment, I'm seeing 1.5 to 2 investors from out of town trying to take advantage of their pain points and get into the market. So when you look at Chicago, when you look at, the locals racing out, and the out of towners racing in. We really want to put that in perspective when we analyze some of these negative outlooks that we see, and take a look at Chicago. You know, it was just rated by United Bank of Switzerland as being the most balanced economy in the United States. People from out of town are really looking at that and trying to take advantage, Travis.
Definitely. Great information there, Vince. Thanks for providing some positive outlooks for investors that's thinking about actually coming into the Chicago market. Now, when it comes to actually investors that's already here in Chicago, Cody, can you provide us with some information as to how some of those investors can force appreciation in their property, especially with some of the negative outlooks, such as property taxes rising, or when it comes to tenants' rights?
Definitely. So there's a few ways to force a bit of appreciation. Our hot button topic right now is going to be the ADU pilot zone. There's 5 areas in Chicago that starting May 1st, housing providers will be able to apply for an ADU, not a variance, but will be able to apply to establish an ADU in or on their on the premises of their investments, which is a great way to just force appreciation, because you're adding a unit or 2 units to an already existing structure, and more money ends up being more equity when it comes time to sell or refinance. Opportunity zones are another way to take advantage of these. Is another thing that we can take advantage of here in Chicago. There's some news coming up soon. We don't quite know what it is yet, but involving opportunity zones, and I'll be happy to share that as soon as we have it. But a majority of our investors that take advantage of those do it for the tax shelter reasons, to essentially not pay taxes on their capital gains, because there is a way to do that. If you have any questions about the ADU pilot zones or opportunity zones, be happy to discuss that further.
Yes, and please feel free to drop your information in the chat. Once again, we'll provide that information over to you, as well as like information regarding 1031 exchanges, opportunity zones, ADU pilot programs, and any programs that's really positively affecting investors and owners here in Chicago. Mo, can you provide us with some opportunities that the Multifamily Investment Advisors team are actually that we actually have on the market today that kind of hit those buckets, whether it be the ADU pilot program or opportunity zone?
For sure. Thank you, Travis, for that. Yeah, we have 3110 West Lindale. It's actually in an ADU zone. And also it's kind of in a suburb within a suburb. It's located in Palmer Square, which is the best neighborhood in the Logan Square, not far from the Palmer Square Park. And it's beautifully updated, newly remodeled kitchens and baths. The second floor apartments are duplexed up, giving it additional increase for rental income. And there's an opportunity to duplex the first floor units down following that trend. And each unit can raise rents by an additional $500 to $600. So yeah, that the proximity to the expressway is a great desirable location, high renter demand location. We also have 12501 South Ashland, is in Calumet Park. That is also a very desirable location. There's a 6 unit, it's a 6 unit, and it's well located, high renter demand as well. And the entry level, it's good for a new investor looking to get in the commercial space. It's 100% occupied and 100% collected. It's a half a block away from shopping centers, from the 119th shopping center and the Metro as well. So you can get downtown. The Metro is a half a block away. So it's conveniently located, and it's at an 8.25 cap rate. So it's a great, safe investment for new investors looking to get in the market. And we also have a 100 unit portfolio. It's common. We're hearing a lot of realtors just in passing in talks that there's no inventory. We understand that there's less than 1% of distressed sales happening in today's market. And this will be a great opportunity. We have 100 units scattered throughout the South Side for investors looking to, get into any flips or looking to acquire any rental properties. It's made up of 2 and 3 units, as well as it's 39 single family homes, as well as a few 2 and 3 units as well.
Thanks for that information, Mo. And if you would like some additional information regarding the property on Lindale, the property on Ashland, or that 100-unit portfolio that we are offering, please, once again, feel free to either leave your chat information in the chat log there, or reach out to a member of the team, and we'll be able to get that those offering memorandums over to you. I'm going to let Tony Hardy, our executive director here on the team, actually go over some information when it comes to the actual commercial real estate market.
Hey, thanks for sharing that, guys. Excellent presentation, excellent information as usual. I'm going to tie in a lot of what you said here into some things we're seeing in the actual marketplace today. Can you see my screen?
Yes, we see it fully.
Awesome. So one of the things, the House bill to allow rent control in Illinois advances. There's a lot of debate on both sides on whether it helps or hurts tenants. The proponents of the bill says that it will slow down gentrification in the neighborhood. The landlords, of course, are concerned, as am I, about some of the unintended consequences that may come as a result. My main concern is that the neighborhoods that have rent control, now the 5 cities where there is rent control, those are the most expensive places to live, and rent control wasn't just introduced there. So for instance, New York City, rent control was introduced in 1943. So I think that if it would keep rents down, then rents would be low in that city. San Diego, San Francisco, Oakland, California also introduced rent control in the 70s and 80s. And of course, Washington, D.C. Those are places where it's still very important, very expensive to get an apartment. But I'm sure that we'll keep our eye on that, and that's not the intent of the legislation. Some of the things that we're seeing in the market is confidence with regards to commercial real estate is varying so much by sector. The sector with the least amount or least amount of confidence, of course, is hospitality. We aren't seeing a whole lot of people wanting to jump into the hospitality space, but there are some guys that are calling regularly, surprisingly, looking at hotels because they feel like they're on the ropes and they feel like they may be able to get a great deal. One of the industrial sector, 100% confident. There's a lot of investment activity in industrial as well as retail. Especially those retail investments that have proved to be COVID-proof. Some of the casual dining took a big hit, but a lot of the fast food restaurants did very well, and we get a lot of demand for those, as well as apartment demand is still moderately good. I know a lot of tenants, landlords want to track rents. We're looking at rents on a twice monthly basis. We're checking rents around the 6th of the month, and as of the 6th of March, we're seeing somewhere around 79% of collections collected. When we look at last year, around the 6th of March, it was somewhere around 82%. So it's down slightly. That slight dip, we're looking at over 11.6 million households in conjunction with the National Multi-Housing Council. They're looking at data from different sources that collect in rents. That a lot of the software that apartment owners are using to get the information is feeding directly into there. So 11 million households around the country. But what we found is that that by the end of March last year, even though that was $400,000 less households this year, when you look at the percentage change, by the end of the month, it was 93%, and we're looking at that trend continue. Where by the 6th of the month, rents are not in, but by the end of the month, a lot of those tenants are either getting the rents in or doing the right thing, getting on a payment plan and things like that. So we're March 2020, it was 84% by the 6th of March, and 2021 we're at 80%. So that is a little bit of a decline. What we did also see is that households are more confident that they can make the rent payments this year. When we look at last year, February, March, there was little to no confidence that they could make a rent payment, looking at all the turmoil, all of the job loss and all of the things. This year, we got the stimulus checks in January. I think that's done a good boost. We're going into tax season. Those tax refund checks are coming in, and the long-term unemployment, people being unemployed more than 6 months, that number is not as bad as we thought. So when we look at the confidence levels, that's good. I think we talked about the confidence level by sector. And the last thing I wanted to talk about is cap rates in the Treasury, which Drew Heitzman spoke about a little bit earlier. We are looking at, we're going to be a little bit of a bump into an inflationary cycle. However, the long-term implications of commercial real estate is a great hedge against inflation. We're looking at that being a short-term bump, and a short-term bump, typically the commercial real estate is a long-term gain. So we feel like you'll be in a good place with your investments in real estate. Especially you look at something like a retail investment where you got a 10-year lease. A lot of times you have inflation built in, where you get annual rent bumps or semi-annual rent bumps to keep up with inflation. Also, there's cost of living adjustments and things like that. So the bond market, we're looking at the cap rate spread between the 10-year and the and cap rates. We're just at the end of 2020 when the rates hit that 2.5%. That was a 10-year high. That was a 10-year high between the spread, and of course the interest rate and the cap rate are in relationship. It just gives an investor a few more dollars that they can invest to get the same yield or return that they're looking for. With that said, I'm going to turn it back over to Travis. And also, one other thing coming soon. I know Jason talked about a development opportunity or development opportunities, and Cody touched on ADU pilot zones throughout the city. Coming soon, we have a redevelopment opportunity in the South Loop, 1507 South Michigan Avenue. That'll be coming soon. A building that could either be repurposed for I think it'd be an excellent opportunity for multifamily, or owner user looking to control their own narrative and get out of the downtown office building. They could go into that building and control their own narrative in the office space. But reach out, look for more coming on that from the investment team here at KW Commercial.
Thanks, Tony. Definitely great information, especially that redevelopment project at 1507 South Michigan. Definitely looking to get that in front of a lot of investors and owners out there. And I also want to thank everyone for joining us today on this Monday for the multifamily market update. Once again, we have these every Monday at noon. We'll be presenting a multifamily market update as the Multifamily Investment Advisors team here at KW Commercial and Keller Williams One Chicago. Make it a great day, guys.
Thanks.